Hello, everyone. Thank you for joining our webinar on mandatory loan sales. We'll get started in a second here. My name is Danielle Dvorak. I'm a marketing coordinator, and I'm here with Scott Hull, Regional Sales Director. A few housekeeping items before we get started. The recording will be available as well as a slide deck after the webinar. And then please go ahead and use the question drop down at the panel if you have any questions for Scott, and we'll go ahead and do our best to get those answered during the webinar. So yeah, I'd like to introduce you to our speaker today. It is Scott Holtz, our Regional Sales Director, and thanks, Scott, for joining us. Go ahead and take it away.
Awesome, thanks, Danielle. So yeah, as Danielle said, I'm Scott Holtz. I'm down in Texas and I'm the sales director for MCT's South Division, or sometimes I call it the South Central Division. So been at MCT for a couple years, but I've been in the mortgage business for actually almost 40 years, and mostly doing correspondent lending or secondary marketing. And I think this is my favorite job I've ever had. So I'm really excited to talk to everyone today. Like Danielle said, please raise your hand or what have you to get a question in the chat box. I think this presentation will be well less than the full hour, so we should have plenty of time at the end for Q&A as well. And I also was going to mention that at the very end there's a sales map with contact info in case you want to reach out and ask any follow-up questions to myself or any of my colleagues. So I think we were going to have like around 200 people on the webinar, so we're going to go ahead and get started. With a group of this size, I'm sure we have a variety of companies that, all do things slightly differently and have different volume profiles. But, I'll assume that if you're not already, hedging your pipelines, that you're a relatively small to mid-size shop. So we're going to try to cover the basics and make sure we answer all your questions. So Danielle, then if you could just put us on slide 2 there, that would be great. We're going to take a look at the 3 main questions that most lenders ask when they start thinking about moving into mandatory delivery. The first one is, how much more money am I going to make by doing this? And then, how much more risk will I be taking on to make that extra revenue? And then finally, what sort of changes would I have to make in my organization to make all this work? So I'm going to try to answer those questions in order during the presentation. But you'll see, as we go along, a lot of the answers are kind of interconnected or interrelated. So we might jump around a little bit, but hopefully will make sense. Before we get into the questions, I was just going to take a minute just to assure everyone that you've definitely come to the right place. MCT's been helping lenders make this move since our company was formed in 2001. Our history has kind of been taking smaller to mid-sized companies and helping them make this transition. Although recently we, really been taking on a lot of larger, more complex clients. So we can really cover the entire gamut. One of the things that makes us so successful is that we've had this culture of teaching and consulting and hands-on customer service, bringing on the smaller lenders, and that's kind of made us who we are today. I also would just tell you that it's not an exact science, but by surveying the correspondent investors who see all the bid tapes from all over the market, we believe that over 50% of all the lenders who sell on a mandatory basis to the aggregators are MCT clients. So we definitely have a big market share and really like to think that we're experts at this. So let's get into question 1 and cut right to the big thing that everyone wants to know is what's the pickup going to be from doing this? And the short answer is that historically, lenders have consistently made an additional 20 to 30 basis points by moving to mandatory. And Danielle, if you could go to the next slides where we talk about maximizing profits. This is you can see the range of the pickup between the best effort and mandatory pricing from the aggregators or the correspondent investors. And that 20 to 30 basis points, or even as you can see, there's some variability over the course of the last several weeks in what that range is. it's kind of, I like to liken it to your 401k. You know, some months are better than others. You might have, 2 steps forward and 1 step back, but when you step back and look at it over a period of months, we would definitely expect to see that trend and you to see that pickup in your P&L. Like I said, the primary driver of the additional profit is that spread between the correspondent investors' best effort and their mandatory price. You can see for the government and conventional loans that are charted there, it's been running, 1/4 to 3/8 of a point basically, which is pretty historically normal. What our job is as a hedge advisor is to help you capture as much of that spread as you can. If you knew exactly what loans in your pipeline were actually going to close, you could just lock those in on a mandatory basis and pick up all that additional spread. But since you don't know, we use hedging to capture as much of it as possible. And I do definitely want to point out that pickup is on top of the margin that you already have built into your rate sheet. When you look at these spreads, you can see, some of the weeks are close to 40 or even 45 basis points, depending on exactly which investors you use. But there are some costs involved, and that's why I say, the net amount ends up being closer to that, 20, 25, 30 basis points on a monthly basis. I'd point out, sometimes people who aren't really familiar with hedging or don't know a lot about it might just instinctively think of it as like playing the market or taking on a lot of risk. But really the point of it is to protect that best effort to mandatory spread that we showed you. So I like to think of it more as like an insurance policy, and we'll talk more about that when we get into the risk question in a second here. So Danielle, if you could go to the next slide. The other key piece of maximizing your profits is to make sure that you're getting the best price possible when you've closed your loans and you're ready to commit them. We like to say that we have a conservative hedging strategy and an aggressive loan sales strategy. So, when you're hedging, instead of taking a 30 or 45-day best effort lock with the specific correspondent investor when the borrower's ready to lock in, and you wait until closing and you take a 5 or a 7-day mandatory lock, and you get that pickup from the mandatory pricing that we were just looking at, plus you get the improvement, from having a shorter lock period. Secondly, rather than being locked in with a specific investor at the start, when you wait until after closing and put those loans out to bid to every approved investor that you have, that competitive bidding process, further sharpens the price that you see. And then on top of that, MCT has this unique tool that we call the MCT Marketplace, which can provide you with shadow pricing from another, 20 or so investors that you're not already signed up with, maybe don't even know about. So you're constantly, being aware of new opportunities to get more revenue from those additional buyers out there. Your trader will work with you as you get going with us, and over time, we're really good at optimizing that investor set so that you're seeing pricing from the best group of people possible that line up with your business. Go ahead and go to the next slide, Danielle. The MCT Marketplace platform that I just mentioned is a great example of the kind of innovation and technology that we have. I don't want to make this into too much of an MCT commercial or get too far into the weeds, but wanted to mention 2 of the other big tools that we have. First, there's TAM, or Trade Auction Manager, which is our proprietary trading platform with broker dealers that helps you squeeze out, a slightly better price on your TBA hedge trades. And then there's our automated assignment of trade, or AOT, which improves your execution by signing over your hedge trades to the correspondent investor when they buy your loans instead of pairing out of the trade with the dealer. We'll talk more about that. But none of the other firms have these tools. The other hedge firms are competitors. And each one of them, really provides a way to wring out a few more basis points on your loan sales or save a few basis points on your trading cost. And all that adds into that capturing as much of that spread as you possibly can that we've been talking about. And then just to wrap up the answer to this question, just for perspective, if you're closing $10 million a month in hedge loans and you net an extra 25 basis points, I mean, that's $25,000 in revenue or $300,000 a year straight to your bottom line. So obviously the more production that you have and the more that we can help you drive up those bips, the bigger that bottom line number is going to be. But hopefully that just kind of gives you something to whet your appetite. So let's go ahead and move on to question 2 in the next slide, Danielle, and talk about, how much risk is involved in this really. I mentioned before, if you do this right, hedging is really more like an insurance policy that protects your profit margin. And we're going to get into the nuts and bolts of that now, which I think is going to help clarify some of the information we actually already covered under the first question as well. So the way this works, instead of taking out a best effort lock, you take out a TBA security position with the broker dealer as your hedge instrument. And that would offset any market fluctuation in the value of your loan while you're processing or closing it. You can see in the illustration, if the rates go up while you're manufacturing the loan's value goes down, but the value of the TBA goes up, and then vice versa on the other side. So what exactly is a TBA? If you may not know, TBAs are tied to the mortgage-backed security market. And as you might guess, it stands for to be announced. It's essentially just a commitment to sell a specified dollar amount of mortgage-backed securities to the dealer at some point in the future. So you take down this trade and you're obligated then to deliver the mortgage-backed security portion to them. Usually these trades are done in $500,000 or $1 million increments. And since the pool hasn't been built yet, it's just called a TBA. So in theory, you'd create a large mortgage-backed security each month with all your loans, and then you would chop it up and allocate portions of it, of that security, to fill each of your TBA trades that you've taken down. But probably most of you don't create your own mortgage-backed securities. Most lenders don't. So rather than creating those pools, what happens is as you close your loans, you take down these short-term mandatory locks with the various correspondent investors, and you buy back an offsetting amount of the TBA positions from the broker dealers. If the hedge works properly, the difference in the price that you see when you originally sell the loan and then buy it back, when you sell and buy back the TBA position, it should be the same as the difference in the price of what that loan could be locked for. So you're not making money off the hedge. Your pickup comes because now you're getting the short-term mandatory price instead of a 30 or 45-day best effort price. So just as an example, maybe this will help. Let's say you could have taken down a best effort locks for 101, but instead you put that loan into your hedge. And now a month's gone by, the loan closes, and the market's off a point. So you've lost a point by not locking that loan in at the start, but you would have made a point on your trade because you're buying back that position at a lower price than you originally sold it for. So that 1 point is a wash. But now when you commit your loan, you're able to commit it on a 5-day mandatory lock and get, that extra 35 or 40 basis points that we were talking about because of mandatory pickup. So I hope that helps make sense. Another thing from the illustration, you see, you're not locking in a specific loan or even a group of loans with the dealer when you take these positions out. You're committing to deliver a dollar amount. So instead of locking the Smith or the Jones and the Miller loan, with a correspondent investor, you take down a $1 million TBA position, and then you're free to slot any loans in your pipeline against that trade as they close. So that actually gives you more flexibility compared to a best effort lock, where you have to deliver a specific loan for each lock that you take down. And in that respect, best effort can actually be more risky than hedging. For example, if you have a situation where the loan characteristics change or you discover some sort of guideline or overlay on a loan that you can't deliver it to that original investor, and you have to, break that lock and relock it at current market somewhere else and eat the difference. So in a mandatory environment, you wouldn't ever have to worry about recommitting because you always know exactly what each closed loan looks like before you commit it. So again, in that respect, mandatory is much more flexible and less risky actually. So the next thing, you might wonder about as you look at this slide is how the math works out when you're doing these TBA trades in million or $500,000 increments, but you have loans that are in all different sizes. So this is where it's important to understand, we're not hedging each individual loan, we're hedging your pipeline as a whole. So that not every application that you take is actually going to turn into a closed loan. And we have what's known as a pull-through model, which uses a whole bunch of inputs and assumptions to determine the percentage of your pipeline that's going to eventually turn into closed loans, and then we make sure we have the right amount of coverage on that. You can probably guess, our model is pretty complex, but essentially how we start off is just looking at the production data in your LOS system for the last couple of years. And we analyze your pull-through statistics for all the different loan characteristics and stages, and we were able to project the percentage, of your current pipeline that needs to be hedged or covered. In the old days, the secondary guys would just say, oh, well, we normally close 75 to 80% of our loans, so we'll just put on that much coverage, which might work fairly well, in a super stable market, which we don't have. So we customize the pull-through expectation or projection for each type of loan, and we incorporate all the known, bond market behaviors, and we apply this series of adjusters that fine-tune that exact amount of coverage that you need. You may have heard about some of these terms if you've looked into hedging at all, or the bond market, duration, convexity, and moneyness. So there's a lot of complex factors that go into our model, and we don't have to get into how all of it works today, but we do like to work with our clients over time and help them understand exactly how it works. So lots more to come on that as we work together. I don't want to gloss over, that there are some risk involved in hedging, but the good news is I think we can work together to greatly reduce or even eliminate those risks. Daniel, if you could go to the next slide, the first two that I'll mention, are really closely related to each other and are almost always the cause, if we have a client that is struggling, and that is if you don't follow the best practices around hedging and pricing and things like that, or you're not maintaining accurate data in your LOS, then you can get yourself in trouble even with our model. We don't see it very often because we have great working relationships with our clients, but you can imagine we've seen a lot of good and bad over the years, and we're not shy about sharing what we see that does and doesn't work. Like for example, it doesn't matter how well the hedge works. If you're consistently giving away free extensions on your locks, you're not going to make the sort of pickup that we've been talking about. So we have best practices that we share with people about how much lock extensions should be costing the LO or the borrower. We have a lot of strong opinions about things like lock policies and what sort of loans to exclude from your hedge, and how often you should do loan sales. I mean, they're small things, but they all add up to impact how well you perform overall. One of the biggest best practices is making sure that your LOS data is as accurate as possible. So if you have bad data in your system that you're passing through to us, and it makes our hedging calculations a lot more difficult. And that usually also makes it really hard for you to track how well the hedge is working for you if you don't have the right metrics. So you're gonna be seeing tons of data and performance tracking from us in our real-time website platform and the reports that we send out every day, but the information is really dependent on getting good data from your system as well. And then another important element of all this is just good communication with your MCT trader. You'll be closely, monitoring your stats and making adjustments and working closely with you. And by having those good lines of communication, we really feel like we can minimize these risks that we're talking about by working together. Again, so it's hedging isn't necessarily risk-free. But we have a proven track record of helping clients avoid any major pitfalls and working through all kinds of different markets. Okay, so let's go to the next slide. Our third big question, what sort of operational or organizational changes are required, to move into mandatory delivery? While it's not always true, usually best effort shops need to do some work to centralize their lock desk and create policies and procedures that mesh better with the new, reality of mandatory deliveries. You absolutely can't have, the LOs or branches locking their own loans with investors or making decisions about breaking locks or anything like that. One of the benefits of not having your loans committed to a best effort investor on the front end is that you're not, beholden to that particular investor's policies on things like extensions or rate renegotiations or overnight protection or even lock periods. You can create your own standard policies that work best for your company, but you really need that centralized lock desk environment to make that work. It can take a little bit of work to do that, depending on how LO-centric your current company culture is. But we've got lots of, like I mentioned, best practices and are able to help you get your arms around that. And once you get these controls in place, you'll actually be amazed at how much money you're able to prevent from leaking out the back door with the LO-centric model. And we'll talk more about this in a minute, but MCT actually even has an outsourced lock desk option available that can help you with this transition, help you implement some of these changes if that's something that you need or are interested in talking about. Let's see, the next really big key change, is that your delegated underwriters will need to begin approving loans based on the more general or more generic guidelines instead of underwriting to the specific requirements of, the upfront best effort investor. So note that I did say delegated underwriting, so that really is important as well. This doesn't mean that every loan has to be able to go to every investor. You don't have to completely redo, your guidelines to make everybody distilled down to the lowest common denominator. We can build these what we call can't go rules that allow your underwriter to flag a loan and make sure it doesn't get sent out to bid to an investor that it's not eligible for. And I know it sounds a little bit complex, but really with the PPE rules and so much better AUS engines that we have today, and these underwriters, that they have this uncanny ability to, juggle multiple sets of guidelines. So this transition is really not all that difficult either. Next, we'll talk about your accounting folks. We will need to make sure that they understand how to make the additional entries related to hedging each month. Once you start hedging, usually you're required to follow the rules for derivative asset accounting if you're not already, which is essentially just like accruing the projected gains or losses in your pipeline and then the offsetting gains or losses in your hedge trade. Fortunately, MCT's got this covered for you as well. We've got a really straightforward report set with month-end journal entries that tie out to the loan level details in our other report. It really totally eliminates the scariness of this for your accounting folks. And we actually even have a white paper that we have published with Richie May that can provide your accounting folks with more comfort on this and a lot of details about how it works. And then another accounting related item to mention is that you'll have some new cash flow changes that they'll need to be aware of. As I mentioned before, when you go to sell a batch of closed loans, which normally happens about once a week for lenders that are getting started with us, you'll also then be buying back a portion of the TBA positions that were used to hedge those loans. So just like today, on the loan side, you'll receive the cash on your loans within a week or so after delivery to the correspondent investor. But the TBA trades actually only settle up once a month, right around the middle of the month. So if you have a gain in your hedge and a loss or a lower value in your loans, you'd be receiving slightly less cash from the investor when they purchase them. But then maybe 2 weeks later, you'll receive the hedge gain from your broker dealer on TBA settlement day. Same thing in the other direction. If you have gains in your loans and losses in your trades, you'd be getting extra money from your investors up front. But then, you'd need to wire the money for the trade losses on settlement day. So It's not a huge change, but it's something to be aware of. And the more that the market moves, the bigger the amount of that timing difference can be. Again, it's just something that your accounting and finance folks need to know about, especially if they're going to have to wire out funds on settlement day for their TBA trades. I mean, that'll definitely be something new, and as you can imagine, the dealers don't really like it too much if you miss those settlement dates. So one last operational note, we touched on already. It's really important for all your departments to maintain clean data in the LOS system. Just a couple of examples. You got to make sure your loan status updates made by your processors or your underwriters. Those are critical, making sure that those are flowing through correctly. If there's any changes to the loan characteristics that would impact the pricing, like FICO score or LTV or any of those type of inputs, those really need to be up to date. And certainly any like loans that get canceled, those cancellations need to be processed as soon as possible by your lock desk so they don't stay in the hedge. So I don't think any of this on the operational side is really rocket science or anything like that, but it's important to be aware of, and like I said, we'll definitely be helping you along the way as you get started with us. So yeah, so as we start to wrap up, Danielle, if you could just go to the next slide. I think the overarching question, when you're looking at this is mandatory delivery right for my company? And so just to kind of recap some of the stuff that we've already talked about, first, you need to be consistently closing, probably $10 to $12 million a month in hedgeable loans. And when I say hedgeable, so normally you wouldn't include jumbos or non-QM or non-delegated loan programs in the hedge, maybe not ARMs. So you need about 10 million in the more kind of plain vanilla production to really make it work. People have been throwing around that $10 million number for a long time, and actually you can make a case that 10 million was too low back in 2021 when volumes were peaking. Guys that were doing 10 million back in 21 or maybe only doing 4, 5, 6 million today, and hedging might not make sense for them. But I think we've probably bottomed out and have some good growth opportunities going forward. So I feel like if you're doing 10 million today or getting close to that or expecting to get close to that in the next few months, that's a really reasonable number based on where we are in the market cycle today. Next, you need to be able to make those operational changes we discussed, especially the centralized lock desk and the delegated underwriters that can sift through those investor guidelines. So you need to be confident about that. And then another thing is you need to work with your correspondent investors and your warehouse banks if you're an IMB to get specific approval to do mandatory. And if you're new to hedging, you probably don't have those trading accounts with the broker dealers that we talked about earlier. But yeah, these are all areas where MCT can help too. We have extensive relationships with all these key counterparties and can definitely help facilitate those approvals. Another thing to think about when we talk about these approvals is you probably need to have close to or at least $2.5 million in net worth to get set up with these top mandatory buyers. And you'll need to evaluate your liquidity to make sure that you can manage those changes to your cash flows that we discussed. Now you can probably get by with a lower net worth since there are some investors out there that'll go down to as low as $1 million for mandatory approval. But it'll be harder to have the optimal results without having approvals from some of the bigger guys. So we kind of like that $2.5 million number, or at least marching towards that. Okay, one more next slide here, Danielle. As you're thinking about this, and if you're thinking it might be good, but a little bit worried about, taking on another project to implement this, I just want to assure you again that MCT is all about making your life better, not harder. We really are here to help. I talked earlier about how we pride ourselves on our culture of customer service, and that certainly applies to the whole setup and transition process. We really do a huge percentage of the workload around getting you set up, setting up the integration with your LOS system, and then mapping your data into our platform, getting the pricing feeds from your investors in place, and helping you get your broker dealer relationship set up, all that stuff. And then once you're up and running, you'll have a specific assigned trader or perhaps a trading team that you'll be talking to almost every day and sharing a lot of good information. We're just really kind of famous for our ongoing training and education, sending out newsletters and market flash emails, and webinars, white papers, and we even have a series of MCT University recordings for people that want to dive in deeper and keep learning more about the secondary market, or some people even use it for new hire training. So lots of educational materials and support for the industry, some of which is wide open and some of which is geared just towards our clients. Okay, and then let's go on to the next slide, Danielle, and I just want to give you a visual of, depending on what your particular business model looks like. We have some other services that could be helpful to you. It's a little outside of the scope of today's call, but we can do things like set up rate sheets for you. As I mentioned, handling your lock desk on an outsourced basis, managing your MSRs if you're retaining servicing. So if you have questions about any of this or want to talk more about how this whole hedging thing works, we've included this one last slide with a map of our 5 sales regions and contact info, so you can reach out and find more information about what to do next. So we would definitely like to talk to you more and help cover any questions that came up from today, or anything that I missed, or any additional information that you think you need. So as I promised, this wasn't going to take anywhere near the whole hour, but hopefully, it's giving you a really good overview of what all would be involved, and definitely are open to taking any questions that there might be out there.
Hey, Scott, we did have some interest in that Richie May white paper that you mentioned earlier in the webinar, so we'll be sure to get that out in the follow-ups as well for any others that might be interested. But as far as questions go, yeah, if anybody else has any questions, go ahead and drop them into the panel. Let's see, we got one just came in right now. Has your team analyzed profitability gains delivering e-notes compared to paper note delivery?
No, I'm not sure that I'm not sure that that's really come up. That's really more of a, I don't think there's a difference in the gains, other than some investors will or won't take those, and so you may have a little bit more limited option on who you put your loans out to bid to. So that might actually be a slight deterrent, but you obviously have the operational efficiencies and the marketing efficiencies of having that available to your borrowers. It wouldn't impact the pricing, but it could impact, the set of investors that are available to bid on your loans.
Awesome, appreciate that, Scott. I don't believe we have any more questions after that, so yeah, that'll be it for the questions.
That'll be a wrap. Okay, well, great. Well, we really appreciate people being on. Like I said, really encourage you to reach out to me or anyone else that you see on here that you think would be a good contact for you, for any additional information or that white paper or anything else that we can do to help you. So thanks, everyone. Really appreciate you being here today and look forward to hearing from you.